Okay, folks, welcome back. This is the Friday daily upload for the ICT mentorship. It's going to be just one market, just one setup, just one review, and it's going to be on a commodity market. So I said we would start moving in a little bit into the commodity sector, not disregarding foreign exchange or Forex entirely. I just want to start mixing it up a little bit and providing you an opportunity to see how the signatures and price that I'm teaching you actually do very well in other asset classes. And this is an asset class that I cut my teeth on back in the 90s. So I think you'll find this interesting. So before we get into it, before I add the lipstick to the chart, I want you to take a look at what you see here. And this is soybean futures. And some of you are probably scratching your head, what is a soybean? You'd be surprised where soybeans end up. And the bottom line is this is the November contract or delivery contract for November 2020. All right, so if you are not ready, pause the video because I'm going to start talking about it and put the annotations on. So here's your opportunity to stop it and study it before you see the insights that I'm going to be sharing. All right, so the daily chart here for the November beans, we've had a consolidation all throughout here. And if you remember going back through the free tutorial series I did on the Optimal Trade Entry Pattern Recognition series on my YouTube channel, I don't recall exactly what day it was, but I talked about the daily optimal trade entry for soybean market. And it was underlyingly bullish, so everything in the commodity market rolls forward. So what this means is when we look at like November, this delivery contract month, when you trade commodities, they have an expiration. Okay, so this contract will expire, and for instance, in the month of December, you won't be able to trade this particular contract month. You'll have to trade 2021 beans, okay, the first contract delivery month of 2021. Now, there is a contract trading for August of 2020, but the open interest is larger. It's about 400,000 contracts for the November beans, which is being shown here, versus a lot less in terms of open interest. Even though it's the nearby contract, which would be August, it's nearby contract by volume and open interest. Open interest is how many traders are actually openly involved in trading that commodity. So it's just there's some things, and I talk about this when we get into the commodity section of the core content. So if you haven't gotten that far in to the mentorship, don't let it worry you because I cover all this. Also, for those that are wondering what's it take to trade a market like this, if you're trading the underlying futures contract, you go to Interactive Brokers or another reputable brokerage firm that I do not have any affiliation with. Let me preface it by saying this. I do not have a relationship with Interactive Brokers. I am not an introducing broker. An introducing broker is someone that talks about a brokerage firm to get you enticed to sign up with them. I'm telling you, do not open up with Interactive Brokers. Not because they're a bad broker, but because I'm telling you I don't want any misunderstandings about this. I am not posing as a, hey, everyone go here. All right, so that way you understand. In this mentorship, we are focusing on price action, not opening up live accounts and trading, because that is the fine line that I can't cross. Okay, I'm not licensed to do that, but I'm only using Interactive Brokers website to show you what would hypothetically be required if you were trading the soybean market. This is the amount of money per contract that you would have to have for initial margin. Okay, so initial margin, and you have to have maintenance margin. And basically, I don't even consider maintenance margin. When I was younger, I looked at, as long as I had enough maintenance margin, which is basically like this, the initial margin, you have to have that and a little bit more, in my opinion, to trade the commodity markets. Now, some of you are probably thinking, man, this is too rich for me. I can't trade that. It's okay, because you can do call options and put options, and we'll teach you that here. But you don't need to have this entire amount of money. You can trade it with a lot less. So you can trade it with a lot less capital using call options and put options. So if you're assuming the market's going to go higher, and we're going to assume that for this, we're going to look at how the November beans traded. And before we do it, I want you to take a look at this area right up here. What do you see there? That's a gap. Okay, it's not a volume imbalance. Volume imbalance would be a wick that would trade up into this area here and at least touch the tail of this candle. So that's the minimum requirements for a volume imbalance, where the bodies don't connect and there's an open area of space there. And then maybe there's a wick here. It doesn't have to have a wick, but if there was a wick touching the previous candle's tail here, that would be a volume imbalance. But because there is a actual gap there, it's just a gap. Okay, it's not a volume imbalance. All right, so when price is trading here, what is it doing? Well, it's moving back into a discount and likely to run above these relative equal highs. Sounds like Forex, doesn't it? It's not just Forex, it's price delivery. So above these relative equal highs, we can anticipate a run up into this area here. Now you can take this gap and use the premium side, which is the level here at the close of this candle, and the open of this candle, and split that in the middle, and that would be consequent encroachment. Remember, the middle point of a gap is consequent encroachment. The midpoint of a bearish order block, which would be the mean threshold. So there's two different criteria there, but along the same lines of basically finding the middle point. If I add the annotations, you can see here's the gap, and we're going to look at this price swing here from this low all the way up to this high here. This is the highest among this high and this high, so we're looking at it there. The only reason why I'm using the fib, notice there is no optimal trade entry here. It does go to the optimal trade entry levels, but it's not important. We only look at the Fibonacci fib level 50, okay, or midpoint, because that gives us our equilibrium. Everything to the north of that is a premium market. Anything below it is a discount. So we have to, if we're bullish, we have to wait for the market to drop down below the 50 level, and that would give us a discount market. We're able to be a buyer at that point. The expectation is if we get down into this area here, there should be something on the lower time frames that would promote a bullish scenario, and we'll look at that when we drop down into the lower time frames. But for now, what are we looking for in terms of an upside? Well, we have this high down to this low. If we do trade up and we break this here, this to this should be a projection on the upside. All I'm going to do is take this level here, drag it up right there, and you can see that we have 1/2 a standard deviation, 1 full standard deviation. If we look at the bodies of the candles, if we put the fib on the bodies of the candle, okay, again, accounting for the wicks and the tails as just normal running on liquidity or running stops, the bulk of the volume is going to be seen in the bodies. So if we take this to this, once this high is taken out, 1 standard deviation takes us to this level right here, and takes us right to the butt end or discount end of the gap. So we could be a buyer down here, reaching up into this level here. All right, so for about well, we can look for about $9 a bushel on soybeans, and $9 and, well, this is $8.62. So if we try to get 40 cents out of it per bushel, that would be $2,000 per contract. Okay, so let's take a look at what happened. Price runs up, it nails it, goes right to consequent encroachment, which is the midpoint of the gap. Okay, we're going to look at the lower time frames. You can see how we do drop into this area here, which will be very clear when we drop into a hourly chart. All right, so here is the 60-minute chart for the soybean market, November delivery contract. And we don't need this fib anymore. It's already accomplished the method. And right in here, you see that? One single candle right there. That is your BSI, buy side imbalance, sell side inefficiency. So in here, below that 50 level, and I'll scrub back here so you can see, that's the 50 level. And below that, this is our first discount array, which is overlapping with a bullish breaker. Low, high, lower low in there and running relative equal lows. Coming back, closing in, fair value gap. Market trades down into that. Wait for displacement. It happens. We have a fair value gap right in here. Let me zoom in. Fair value gap right there. Notice the bodies of the candles respecting that. Bodies here. It tails down into that BISI again after spending some time here with the bodies of the candles. We have an optimal trade entry here, and then we have another one here. Fair value gap fills it, order block. Explosive price move, small little retracement. Don't look for this to fill. It's going to try to get up here really quick. And the market does in fact trade up there. Consequent encroachment, perfect. Premium, discount into the gap, midpoint to the cent. So there's $2,000 right there per contract trading the soybean market, and it was only a few days to do that. So it's a very easy short-term trade. You were prompted to that idea if you remember going back through, and you can still find it on the YouTube channel. Again, I just don't remember exactly what day it was, and you'll have to forgive me for that, but it's fairly easy to see if you just go through the videos real quick and look for soybeans in the upper left hand corner in the example, and you'll see that we were talking about a bullish scenario for the daily on soybeans at that time. If I'm not mistaken, I think it was the July contract of soybeans. So I'll just have you look at that and study that in addition to this one. But there's a really, really good example of continuation here. For homework, you might want to look at the sugar market, and I'm not going to give you all that here, but I will share a chart with the Sunday weekend edition. I'm not going to include it in the weekend commentary because it would just make it longer, but I'll add a chart in the post so that way you can see the markups on the sugar market. Same thing, but I think this is most likely going to go a little bit higher too, and I think sugar is going to go up higher as well. Before I go, when the market was dropping down in here, okay, I want you to get a better appreciation for how we track the smart money. And we're going to look at the soybean market here, and this is just the November contract zoomed in on the last 3 months, and here's the price action here. Trades back down in, and notice this, I guess it's purple. I may sound like I'm colorblind, but yeah, it's purple. At least it looks purple to me. The open interest, which is this purple line, takes a nosedive right there, just like it does in here. Okay, so we're in a consolidation. Big drop in open interest. What happens? The market goes higher. Goes into consolidation, drops down while it's inside the consolidation. And what is open interest doing? Declining. That is one of the signatures that you look for with commodities. That is like an inside X-ray view, if you will, of real accumulation and distribution in these markets. The commodity markets really do have a supply and demand factor with them because there's a real tangible need, because it's basically the world's grocery store. So if the countries around the world or the U.S., have companies that want to buy wheat to make bread products, they have to buy large quantities of wheat to do that, and soybeans and soybean oil and soybean meal and so on, and oats and corn, everything. So when we can see the large producers or users of that commodity reflected in short covering, and that means when the market's predisposed to go higher, which is what we're assuming here, and also what we hinted at in the examples in the optimal trade entry pattern recognition series. I showed you a daily optimal trade entry for soybeans. And because the contract rollover that takes place, and what does that mean? It means if you were trading, for instance, the S&P 500 June contract, the symbol would be ESM 2020 on TradingView. But at some point, that June contract would expire, and then you'll have to start trading the September contract, which is what's the active contract right now. So the symbol would be ES U2020 for the September delivery contract for the September S&P mini futures contract. Well, the same thing happens for soybeans. So if you're trading the July contract, it does offer an August contract, but the general rule of thumb is July, when it expires, you want to jump to November, because November will generally have the most open interest and volume, and that's what we're showing here and why we're showing it. It's jumping that far ahead. Okay, so if we see open interest declining like this in such a degree, and I teach again more about this in the later content of the mentorship for commodities, but this is one of the signature I like to see with an underlying bullish setup that just makes it just really, really easy to see. Now, full disclosure, I did not take this trade. I haven't traded commodities in a long time. But as I have mentioned on Twitter and even in previous recent commentaries, I am really getting prepared to go in heavy with commodities, because I think because of all the COVID-19, all the things that's been shut down, one way or the other, food is going to get real expensive. Okay, and it starts here at the commodity market. And I believe that we're going to start seeing issues with the crops, issues with livestock, and all the food groups like cocoa, coffee, sugar, as I mentioned earlier, and even orange juice. And I think these markets are going to start heating up. And we have to watch the dollar to confirm all that, obviously, because it'll be a diametrically opposed scenario. The dollar should be dropping if that's going to happen. But I'm not saying that the dollar's going to crash right now. I'm saying that we are watching it, because if the dollar starts to break down, the commodity markets are going to get really exciting, and it's not going to happen real fast. It's not like we're going to miss something. It doesn't have to happen a day by day daily review of it. I'm keeping an eye on it. When it does give me the things I'm looking for, we'll start talking more about it. But nonetheless, this drop down in open interest indicates short covering by the commercial traders. Commercial traders are like Kellogg's, okay, or Nabisco, okay, big, huge companies that make a lot of product with a commodity, like, for instance, like soybeans. And soybeans find their way in a lot of different types of foods. So if we see a drop in this open interest, what that's indicating is now this is the big caveat, if the market is in consolidation, sideways, but slightly bullish, and we get to an area where it should trade higher, as we've shown on that chart here, okay, what's being shown here is not the same time frame. Obviously, this is 3 months on a daily basis. So each one of these candles is just one single daily candle, but it's just looking at the last 3 months, so you can really hone in on this decline in open interest. And what's that saying? Its meaning is that there is a lot of short covering. Now, if a large commercial entity like Nabisco or Quaker Oats, something like that, drops in open interest like that, reflects their covering of shorts. They don't want to be short because they think the price is going to go higher, and they hedge to reduce and manage the overall cost of doing their business. So if you ever see a drop down in open interest like this, when it's bullish, this is like a no-brainer lead pipe cinch trade, as to quote my initial mentor, Larry Williams. That's where I got that saying from. And it really means exactly what it sounds like. It's like walking up to someone and just blast them in the head with a lead pipe. They have no chance. And that's the type of reaction you get. It's just so one-sided, so easy to see. And it's a standard optimal trade entry with fair value gaps, as I mentioned, on the lower time frame. And the kicker is this right here. If this is dropping down at the same time, man alive, is that just an easy setup for longs. And look at the reaction. Does it go up like it does here and then a little bit here? No, it's dynamic. It's very explosive, and then poof, you take off like that. When the markets do go to a condition where the commodities are really explosive and they go to premiums, now not the same as that range I give you when I look at the fib like the high end would be premium and low end would be discount. When I'm saying premium as it relates to commodities, that means that the contract delivery months are going to be more expensive nearby today's date and less expensive in the future. That's actually a reversal of what was normally seen in a carrying charge market. Now, a carrying charge market is a market that sees futures contracts. For instance, as I mentioned, when July was trading for soybeans, that month may be trading at, say, and I'm going to just pick out some rough prices. I'm not saying these would be attributed to the actual prices of the July 2020 soybean contracts, but the normal price structure would be July could be $8.60, and then August could be $8.65. Notice it's getting more expensive as you go further away from the current date. And November beans would be something like $8.75 a bushel. So there, it's usually in a carrying charge market, which is a normalized market. In the commodity market, it is more expensive as you go further away from today's date. The reason why is because there's more costs in producing, handling, insuring, raising, especially if it's like a livestock, or growing, in this case for a crop. Those things cost more money for the producer of it. So they want to make sure they price all that in. But if that structure ever inverts and shows that it's less expensive as you go further away, that is an indication that there's a huge demand for the commercial consumption of that commodity, because otherwise they would wait to get delivery later on. Whereas right now, they don't want to wait because it's going to get more expensive because of the premium that's built in. They have to do business right now, and they can wait for it to get cheaper, in other instances. But if they think that the market's going to go up higher and stay up for a while, there's going to be a pent up demand, a real demand for the commodity. So they're going to be willing to pay a higher price right now versus more in the future, which would be a normal carrying charge market. So anyway, I felt that this was a good example to start moving us into a generalized discussion of commodities. Again, please do not be fearful that we're going to go right back into Forex too. But I just want to show you the versatility of what you're learning. It's not a one-trick pony Forex approach. I'm teaching you how all these markets work. And you're not limited to any one particular asset class. You're not limited to any one particular trading style. So until I talk to you on, I guess it's YouTube tomorrow, because I'll be doing a free discussion series on what I do if I had to go back to square one, and how would I approach that. So I have put some thought into that, and that'll be a 4-part series, 1 video per week, and it'll be a Saturday release. So, and then on Sunday, obviously, I will have the weekend edition for the mentorship. Until I talk to you then, I wish you a pleasant weekend. Happy 4th of July.